But we are thrilled today to be joined by local chief investment officers to share their candid insights on navigating today's complex investment landscape. This dynamic discussion delves into key topics such as strategy, asset allocation, risk management, innovative investment approaches, and the evolving role of institutional investors. Today's discussion will be moderated by Aileen Fogarty, the treasurer of the Robert Woodruff Foundation. She's also a past president of the society, past board member, and the current strategic advisory chairman. Aileen?
Thank you. So glad to see so many friends in the audience, and appreciate everybody coming out today for the event. I'm excited to be here with our esteemed panelists. Instead of doing the typical introductions where we read their bios, we're just going to go down the line and let everybody introduce themselves. But I thought to make it fun that I've asked them to share something beyond their bio that is sort of an icebreaker to kind of get to know them a little bit better. And so I offered that I would start that. So as Bill mentioned, I've been with the Woodruff Foundation now for about 4 years, and I've been in Atlanta my whole career on the allocator side, working at a pension fund and a wealth management firm, and now on the philanthropic side. And the thing that nobody really knows about me that I'm going to share with you is that I've taken drum lessons recently. Drumming is very difficult, so I won't be making any debuts in any bands anytime soon. But turn it over to you, Dave.
All right, can you all hear me okay?
Yes.
Yeah, brief bio and
okay, brief bio. So my current business card says I'm the Chief Investment Officer and CFO at Balentine. We're a 40-year-old local RIA doing wealth management and managing assets for institutions. And let's see, something about me you don't know. Well, that's hard because if I wanted you to know, it would be higher. So, I guess sort of interesting to me is one of my roles after starting this organization was I was the head of risk management. And so you might assume from that I'm risk averse. I'm not really too risk averse. I'm an avid, aggressive mountain biker. So my partners worry about that a little bit sometimes when we talk about disability insurance and life insurance. They wonder if we have enough. So perhaps that's interesting.
Hello, everyone. I'm Vickia Scott. I serve as Chief Investment Officer at Southern Company. Also Vice President of our plan sponsor team called Trust Finance. Something interesting about me is I grew up in the Gulf Coast as a Catholic student. Most of my teachers were nuns. They were very, very strict. The most strict nun I had a ruler, and she used it. And her name was Sister Zoe, and she was very, very firm. Today, fast forward, I have 2 adult children, and 1 son, 1 daughter. And my daughter is named Zoe. And my entire family were perplexed when I named her that because of the horror stories I told about Sister Zoe. But Zoe means life. And the older you get, the wiser you get. I was one of those parents that would visit Montessori schools and say, I don't understand it. I need rules, structure, lines. My nuns didn't allow all this talking and laughing. And but Sister Zoe was hard on me, but I was a great student for Sister Zoe and every other nun I had. So they propelled me. They made life rough, but they also, I went past a lot of finals because I was a good Catholic girl student. So my daughter is my life, my new life, and I love the name Zoe.
So I have to jump in here and tell you something funny about this story. So I got a text a few minutes ago from my son, who's in 8th grade, and he asked if we have a ruler at home, and I said, not that I'm aware of. Do I need to stop and get one on the way home? And he said back, yes, it needs to be plastic, it needs to be 12 inches long. He goes to a Catholic school, and I wonder what they're going to do with that really small.
Right, so Sister Zoe, the rule was the wolf.
That's going to be hard for me to top, especially since my kids go to a Montessori school for many years. Well, I'm Jason Leone. I'm the Deputy Chief Investment Officer for a diversified trust. Probably a smaller presence here in Atlanta, but we have 5 offices around the Southeast, managing, depending upon the day, between 11 and 12 billion in assets for clients. I've been there for closing in on 20 years now. Certainly if you had asked my 20-year-ago self, who actually, Ailey was the one who hired me. If I would still be there, I would have laughed in your face, but here we are. So I guess something a little odd about me is I have a unique last name, and I have yet to find anyone with that last name who is not related to me. So if you see bumping any Leones out there, you can send them my way. They're probably a cousin.
All right, great. So that gives you a little flavor of what we have in store for us today. So we're going to do some Q&A for about 45 minutes amongst ourselves here, and then we'll open it up to the audience, okay? So just to get started, I thought the best place to start would be if you all can touch on your overall asset allocation. So how you think about the portfolio in terms of equity, fixed income, or risk and defensive, and then public and private exposures. Jason, since you went last, you get to go first.
I get to go first this time. All right. Make me go first with the hard questions. Well, right now, we're allocated. We take a very sort of, I think, institutional approach to how we're allocating. So we are always, and our name is Diversified Trust, so no surprise, we're allocated across the spectrum. Our 3 main buckets, though, the way we think about it in terms of risk is with stocks, bonds, and then diversifiers, which tend to be mostly hedge fund strategies because that's truly a bucket that we're looking at to avoid traditional stock and bond risk. So we usually bucket our real estate, especially the opportunistic real estate, in with equity, same thing with private equity, and then private credit in with fixed income. So as around that, our strategic targets for our clients tend to vary, obviously, depending upon how their own risk targets, but we try and, that's how we think of things from a larger picture perspective.
So we are allocated 70% return-seeking assets, 30% non-return seeking. That is driven by the growth of our liability, the pension plan. That's following a de-risking where we actually increase fixed income to 30, so we're actually more conservative. So all of the asset classes just mentioned for us would be in that 70% bucket, like private credit, etc.
So today, where we are, and we're probably more tactical than most, we have models that help us drive where we want to be from a strategic asset allocation perspective, whether we should be overweight or underweight that target. We're at a neutral weight on a stock versus bond basis. So think of risk assets versus less risky assets. We're neutral between those two today. And there's a portion of our portfolio that remains more or less constant, and I'm going to use 20% as sort of a benchmark, but we're allocating to private capital. We're not in hedge funds. You call it diversifiers. I think that's, a lot of people are using that term today, but it's not stock, not bond. So we're using private capital, and that is, in our vernacular, defined as private debt, private real estate, or private real assets, and private equity. So we're more or less neutral across the board right now, and I think that's probably going to get you the next question. Why so?
Sorry, I had to step down. I was about to slide off that chair. For short people, you need to run and start soon and things. I'm way more comfortable here. I hope that's okay with everyone.
No worries. Okay, so I think what we were going to touch on next, to your point, is really any changes or upcoming thoughts around prospecting and what you want to do from an asset allocation standpoint. Obviously, the markets are a little volatile these days, but just in terms of where you're seeing opportunities from an asset class standpoint.
Yeah, so as I said, we're at a neutral starting point, and our systems or processes is more or less quantitatively driven. So we like that because it takes the emotion out of it. And every time we sit around the table as an investment committee and we, pat ourselves on the back for hundreds of years of experience in the room, and every time we make a decision based on that experience, it generally turns out not to be so right. So we rely on our models to tell us and to take the emotion out of the equation. And so where we sit today is we're really going to probably remain at a neutral stock bond weight until we see some steepening in the yield curve, because the relative valuation, which is a big way of looking at things within our firm, it's all about relative valuations, not absolute valuations, is suggesting that there's really not that much of a delta between stocks and bonds. And so if we see the yield curve steepen, or we see a dramatic pullback in equities where they become more attractive on, say, a yield basis, dividend yield, that might make us think about equities maybe more aggressively. Within the stock world right now, we're still very biased towards the US. We know that we've missed a lot so far, EFA being up 10% year to date, EM up 7%. We haven't had much of a tactical allocation, either one of those. That's paid a lot of dividends over the last number of years, but from a relative basis, but this year from an absolute and relative basis, we're behind the curve. So if there were some place where we're going to head next, if we continue to see momentum in international securities, that would probably be somewhere we would head next. Within fixed income, I might go too far now? Or
You go ahead, that's fine.
Within fixed income, we're starting to see yields, we've all seen this in the last year and change, yields start to go up, so active fixed income is going to become probably a larger part of something that we do, whereas over the last, decade and a half, it's been basically, more or less a buffer to volatility in some respects, but it was really hard to make money in the active space. So with yields up, we probably start seeing a little more activity in the fixed income space.
We are really strategic investors. We try to stay away from any tactical shifts in our asset allocation. If I had to put my finger on something I'm excited about or looking forward to this year, is the reward of active management. I think this is going to be the year that some of us are going to look brilliant for picking those managers who are focused on undervalued companies, strong fundamentals, and things that make sense outside of the Mag 7. I'm looking to be vindicated from what I experienced in 24 and 23. I'm hoping to show my committee and my fiduciaries that being patient was worth the wait.
I think our approach is somewhere in the middle between the two of them. We set strategic targets, but then tend to tactically tilt. I think it might have been a Cliff Asness paper a decade or so ago, where it's like, if you're going to sin a little. So when we make tactical calls, we try and sin a little bit. So I think I would echo a lot of what both of them said already. We've tended to, our overarching theme though right now has been the concern over valuations in the market, especially here in the US. And so we've really been trying to make a concerted effort over the last, call it 12 months, to identify more opportunities in private markets where we can get equity style returns without taking direct equity risk. And also then within equity markets, trying to do more in the active management arena. Of course, our clients are individuals. There's a lot of benchmark relative risk that we take by advocating for truly active management, even though I tend to think now is a pretty good time to be moving in that direction. So in many cases for us, it's actually easier to move folks into more private markets. And I don't think it's not even just saying to move to private equity, but I think you can find very attractive opportunities in the private credit space, real estate, et cetera. And we've really been trying to look at a lot of more niche-y strategies where we can find that equity return without the equity risk. That's been our big overarching theme for the last 12 months.
Can I ask a question?
Sure.
What niche strategies are those that you're getting at?
We're going to get to that. So hold on, hold your horses. All right, so you all mentioned a little bit of a shift more in public equities from passive to active, and maybe some more international exposure. I'm just kind of curious, maybe you could, if anybody wanted to add to those comments. Obviously international has been such a laggard for the last few years or decade. and passive's done so well. So I am curious how you all are thinking about that and to what degree, active, you want to hang your hat on active going forward.
Emerging markets equity has been a little disappointing for the last few years. I'm hoping that with the backdrop of the current administration and tariffs and the effects that might have on trade, et cetera, I'm expecting a recovery in some of our emerging markets managers. I'll also mention for a long time, we didn't believe international small cap was a defined asset class. We believed the correlation between large and international small cap was high enough that it didn't make sense to carve it out the way you do US large and US. So I convinced my committee we were ready in 2019, and since then, international small cap has lagged, and I have not looked so brilliant. So emerging markets, international small cap, that's where I'm hoping to get some more flexibility, some good stock selection, and some surprise alpha and return enhancement.
Do you have any doubt?
So, we're big believers that in the efficient market or efficient asset classes like US, large cap, international developed, small cap US for that matter, it's really challenging to be active in those spaces. I'm not saying it can't be done, but what we acknowledge is we're not good at picking those managers. And because we're tactical, it's hard for me to commit to an emerging market equity manager who's active, where I may only be there 18 months. So one of the guys on the team said, speaking of small cap, we'd rather rent it rather than own it. Go there when there's an opportunity. Same thing with international emerging and even small cap in the developed space. So the way we look at it is, and I'm not going to dispute that active management may do really well this year. Time will tell. Just not an area that we're great at. So what we do is we reserve our active risk budget for the private space. We feel there's just a lot more opportunity for private managers, again, whether it be debt or equity, to affect change, look for companies that are really mispriced, and go in and do something with it. Of course, what comes with that is the lack of liquidity commitment you need to make to it, but that's how we're looking at things in terms of allocating our active risk budget more in the private space.
Yeah, I would agree with that. That's we've tended to, even when we've been active in, especially in U.S. markets, it's extremely challenging to outperform there. I'm sure you guys are all extremely aware of that. And why we've tried to do more in terms of having that risk exposure in private markets. We have shifted, we've been massively overweight U.S. for the last 5-6 years, which paid off in spades. We just very recently decided to kind of not completely unwind that, but pull that back a little bit just because the situations have changed. We've seen a big valuation spread, but that in and of itself is not a good timing mechanism, but obviously the macro situation has changed a little bit, and so we're less willing to sit on a massive overweight than we have been in the past. I don't think I have a whole lot to add to what David said in terms of the private markets exposure, other than I think we're excited there is really a lot more on strategies that are smaller on the private market side, going into the sort of lower end growth equity, lower middle market, where it's less about financial engineering and betas and what you can get when you take a company public, and more about the transformational investments and improvements in strategy, improvements in management, and what you can do with a capital injection that hopefully can lead to outperformance no matter what the macro environment is. And I think that's an abiding theme that we've had for the last few years.
I just wanted to clarify one of my comments about public markets. So we do what's called a report card tool when we do our annual manager review process, where we're issuing watch list recommendations. And we use a scoring tool so that, the committee doesn't just have to hear who the kids' favorite people are. That, we're adding some quantitative analysis and not something that's just qualitative. 50% of that score is your 3-year rolling return relative to the year end. So, and I'm what the CFO calls an acting manager. So I still actually oversee a lot of the public equity managers I've hired over the last 20-something years. Last year, we had a record number of watch list managers where I had about 9 across the spectrum where I had to tell the story of managers who adhered to their strategies, did what we asked them to do, but their styles were out of favor for various macro reasons. And when you do that score and you're studying annual returns, what helped, what hurt, you study individual returns very heavily. It's ingrained in my mind. So 2020, COVID happened, people thought the world was over, and then anyone who was tactical that year lost their shirt because the markets, as you know, recovered very well in the second, third, and fourth quarter. 21 was a little uncertain because some countries were still opening slowly, we weren't sure. But in 2022, we saw the most tremendous downside protection that we have offered our participants in our committee in a very long time. So when I say things like I'm looking forward to the return of active management and I'm looking forward to international small cap and emerging markets having their day, I saw that day happen in 2022. I saw the benchmarks fall significantly and we did not. Then 23 happened. That was when the Mag 7 occurred and then we didn't look so brilliant again. And so it's funny, now I feel it's a year-to-year analysis and I'm holding my breath and looking for what a trend might be. And that's really because the market environments are really kind of forcing us to think about it that way. But thankfully, that's just 50% of the score. 20% is peer rankings. How is that manager comparing to other strategies in that same space? Another 10% is risk-adjusted returns, information ratios, are they getting alpha from skill or luck? We don't want managers where we have to buckle up for the alpha. We don't want slim. What's in baseball? Grand slam. We want RBIs, steady RBIs, and so and then another few points for just relationship and the trend that I see with the manager that I'm working with individually. And so after looking brilliant in 22, 23 happened in 24, I had to tell the story of some really good managers that I have a lot of respect for, have a long tenure with the Southern Company, and deserve the defending. But we have what's called a credibility bucket. And some CFOs say, that sounds a lot like what you said last year, or what you said 2 years ago. So I do think this year, just based on what I am seeing so far, it's going to be something similar to 22, where there's a reversion to the mean of what we all know, what we studied in this long-term industry of ours, what we know should work over time. That's what I mean when I say what I'm looking for. I saw it happen in 2022.
I appreciate that. Okay. All right, so we've talked a little bit about public markets. I want to move over to talk a little more specifically and a little more in depth about private markets. But as we're moving in that direction, maybe you guys can comment a little bit on what you're seeing in the public and private investment continuum. So obviously, there's a lot of structures now that are coming out that are sort of public structures or more liquid structures, but they hold private investments. I'm curious how you're thinking about your public versus private allocation in your portfolio and how you plan to evolve that given all these new structures, whether there's something that you think is worth using or not, or how you're contemplating that. And then we'll delve into the specific private markets.
Sure. I'll dive in. I assume you're talking about like interval funds.
Even ETFs that are going to have some, private components to them.
Yeah, I really struggle when you have a major liquidity mismatch between the structure and the underlying investments. Sorry if there's anyone from Blackstone here. I'll apologize in advance. But I do have real concerns, and we have avoided doing anything with like real estate private equity that are these long-lived assets that you can't sell very quickly, and putting them into a structure that provides some illusion of liquidity. I think that maybe is easier for an institution where everyone is very aware of what they're getting themselves into, but I think it's certainly harder with individual clients where we can talk ad nauseum up front about, well, this company or this fund is only going to make 5% of the assets available each quarter. You can get trapped in here, and they just hear, well, I can get 5% out each quarter, it'll be fine. And so we have tended to avoid that as much as we can. I know there are benefits because you can buy into a mature portfolio. It does give you better liquidity than if you just go into a private fund when there's liquidity available. But we've really prized the certainty of the terms and certainty of knowing when you're going to get your money back. The one exception to this maybe is on the private credit side, where you do have a cash flowing asset with shorter maturities. I'm a lot more comfortable using vehicles there. But I think this push to bring private equity to the masses, the structure is a challenge, and then just doing that at scale, I think waters down the investment opportunity as well, because you're suddenly now throwing a fire hose of money out into an asset class where it's getting increasingly hard to find large deals that are additive from a valuation standpoint.
I would say we don't really have a huge liquidity issue, and so our appetite for private equity right now, our target is 9% private equity, around 3% for private credit, and then we have another 3% allocation for what we call special situations. Those are for all the opportunistic investments that come along through market dislocations that don't fit nicely in our other traditional buckets. But I can tell you that the liquidity issue, when it is an issue, is not fun. So our next committee meeting, we are reporting on 2 real estate funds where we were in the redemption queue. Maybe we've been in the queue for 2 years. They are now trying to protect all of their investors, and they're getting stricter with what they're promising in terms of distributions, and they're now lowering the asset management fees to incentivize us to lower our ask for what we need. That is not a problem that I want to increase, right? The first time you have to go to your committee and say, we can't get all the money back, we've got most of it, but for now they're saying, can you just leave us alone a little lower fee, we'll come back to you later. Kind of thing. That's not a fun conversation. I haven't had it yet, I'll tell you later. That's not a fun conversation to have. And so I'd rather separate that liquidity premium and that risk in my portfolio in the way that it should be separated.
I'm not going to add much to this. I mean, in terms of differentiation, listen, there is no free lunch, and that's, I mean, what these are professing. I mean, from the perspective of, how do you get that liquidity? Well, I've got to own something in this illiquid fund that is liquid, so I've got basis risk. We sadly were in one of these lending funds, who I won't name, who was one of the pioneers years ago, and it took us years to get out, because the only time we wanted to get out was when everybody else wanted to get out. And so get in line, close the gate, and several years later you got your money, and you're going through the same story with what concessions are they asking in order for you to pull your money off the table. And their number one objective is they have to protect the investors, of which you are one while you're there, but you want to be a former investor, but you can't become a former investor. So I also very skeptical of the duration mismatch. It doesn't mean it can't work, and it doesn't mean it won't work, but ask yourself what it is you're gaining and what it's costing you potentially. So you're going to get a watered down return for this possible liquidity that you may or may not need. If you have that much liquidity needs, and that's pretty much your client profile, that tells me you're going to need more of the money than not. And so stay away from it. And just go down the path of known illiquidity, and if your client can't accept that, find something else. I mean, you're going to get paid an illiquidity premium, or you're going to get paid a liquidity premium. You can't get paid both. It just doesn't make sense.
Yeah. And I'll just, from the perspective of working at a wealth management firm, it's easy to try and, there's a large incentive to bring something that sounds exciting and differentiated to your clients. And so a lot of this private equity for the masses, et cetera, sells very well. And I know we're under pressure for even getting asks from our clients. Well, I was doing this in my old firm, or why aren't you doing this? I read about in the journal. And, so we think it's incumbent upon us, and it can be difficult, to try and educate the client and not just give them what they're coming and asking for. And that is a lot harder than you might think it would be.
It's interesting, just as a other comment on the foundation side, I will say that because the required return for foundations has to exceed the 5% plus inflation, we see a lot of people reaching for return, and so it's pushing people because they still feel they will be able to obtain the liquidity premium. Whether or not they will, I don't know, but that really pushes people, continuing to push people. And the lower the equity market outlook becomes from a return standpoint, I think people feel like they don't have as many options, and so there's still a big demand there. Let's talk a little bit about private markets themselves and sort of how you guys are approaching those. Private debt and private equity are pretty nebulous in terms of description. So maybe let's start with private debt, and you can talk a little bit about how you guys approach sort of the private fixed income world. What segments are you interested in? Direct lending, opportunistic, other areas that you might be finding attractive or have invested in successfully.
Wants to go first?
Yeah, I'll kick off. We're, like everybody else, seemingly pretty excited about private credit. It seems to be so talked about that the contrarian in me says, what am I missing here? I should be worried because everybody's doing it, and if everybody's doing it, then something's got to be wrong. And so I worry a little bit about that. Is there something going on there? So I think what gives me more peace of mind with the private credit space that we plan is, I think like Jason said, we're in the lower middle market. And what that means for us is we're looking at managers or funds that are making investments in companies ranging from 25 million EBITDA downward. And there are thousands of companies that fit that profile versus the upper middle market where there's a very finite amount, and you've got all the bulge bracket and the larger funds competing for a handful of funds, and so you're effectively, as an investor, a price taker. When you move down market, you are effectively setting the price, and to everything Jason said earlier about lower market funds or lower market companies, you can affect change, and it doesn't really matter what's going in the macro environment. So we like that end of the spectrum. I get more comfort out of being in that area because we're also looking at funds and firms that are making investments that are asset-based loans. So these are funds that in investment say, hey, listen, if you don't make your numbers, we're going to come take the assets, we're going to sell them. And so you have very, very low default rates, if any, and then you get your money back. The other area that we like right now is in the private credit space is lending within real estate. The wall of maturity that's coming up, there's going to be a lot of folks that need to borrow money, and there's going to be probably a shortage of funds coming from banks that want to lend to all these buildings that may be sitting there at 40, 50, 80% occupied. And so in the private space, I don't want to say you can write your own terms, but you can certainly get a premium out of that. And so we're selectively looking in that area as well. So let me stop there and hand it over to Mike.
Yeah. I don't have that echoes a lot of our playbook right now. Kind of in addition to that, we've been also looking at a lot of sort of stressed and distressed credit as well. I think that anything that's been impacted by higher rates, this is a very opportune time to go in and fix broken capital structures with an injection of additional debt or equity. So that's been a big theme of ours here for a while as well. stressed and distressed credit and then stressed and distressed real estate. So most commercial mortgages are 5-year maturities. If you locked in something in 2021, 2022, your refinancing is coming down the pike here pretty soon, and that's for many assets are very strong assets, well leased, what have you. They just are having broken capital structures because the debt was based off of interest rates being 300 basis points or 400 basis points lower than they are today. So that's, I think, the only thing I'd really add to what David said.
I would just say certainly our private credit strategy is newer than our private equity allocation, which is more diversified, but there is some of our lower middle market strategies. We're looking for unlevered sleeves, targeting around 6 to 7%. Right now we're fortunate, our plan is still open. We have a growth rate right now around 7% in our obligation, and most of that is driven by the fact that most of our participants are under a final average pay calculation. New entrants after 2018 are based on a cash balance plan. So we expect for the growth in the liability to come down significantly over time, after we meet the obligation of all of the folks who fall under the more generous calculation. But I said that to say that always drives how much juice, if you will, we're looking for when we enter a new asset class or a new market. We're not swinging for the fences because we don't really need to. Right now we're about 122% funded. That surplus means a lot to us right now. It's hard to get. We want to protect it. So you probably have a lot of closed ears if you were coming to pitch to us for something that sounded a lot more sexy. That's not what we're looking for right now.
So this was from my private credit, maybe if anybody's told me, if you can tell me how you maybe could do this, I'd be really, really interested. So as with some leverage in there, you can get out of private credit, 9, 10, 11%. We have to worry about taxes, so that's important to us for most of our clients. But if I could build a private credit portfolio that was the equivalent of a laddered bond portfolio, I think that's the holy grail. You could marry up liquid, investment grade, stable stuff that cash flows, albeit at a lower number, with a private portfolio that every year is effectively maturing. So if you have a 10-year duration portfolio and you have one that matures in 1, 2, 3, so every year I'm upping and doing something else. But now you got this massive cash flowing asset without any real equity market risk in it, but you're getting returns in excess of what the equity market could do. So that's sort of like the holy grail, I think. And so what you do is you could perhaps marry that up with a secondaries fund, which is cash flowing immediately. And I don't know that we've seen a lot of secondaries in the credit space yet. At least we haven't seen much of that, but I think that's also an area that I would be really keen on looking at. And again, because the secondaries, if you aren't doing those, or if you have, it's got so many benefits to it. You're getting a free look, you're getting a discount. You've got the asymmetry of information is no longer there because it's been in place. There's no J curve, and so I think there's a lot of things that can be done in that part of the credit spectrum that we haven't really gotten into yet.
I don't think private credit's not old enough yet to have secondaries. maybe it'll be coming.
There's always so many ones out. Right?
That's right. All right, let's shift gears and talk a little bit about private equity. And based on the illiquidity that we've seen in the private equity space and probably the venture space as well, I don't know how much exposure you guys have there, but maybe you can address sort of how you're looking at it on a go-forward basis from your starting point as it relates to your allocation relative to target, and then also just where you're seeing opportunities, if any, in that space.
So I'll start. Right now, although our target is 9%, on an actual basis, we're at 12%. And that is due to a combination of things. The denominator over time has shrunk because of choppy markets that we've had. And when we actually did our de-risking analysis and got approved in 2022, we cautioned our committee about sort of sitting on the sidelines when you're trying to get private equity back to a strategic target. You could miss a lot of future opportunity by just doing nothing. And I think CalPERS had a really big article that thankfully a lot of our CFOs read, where they had a similar issue. They pulled back dollars from private equity and they missed and had to forego a lot of opportunity that hurt them in the future. So what are we doing about that? We know that we're overweight on an actual basis. We look at sort of our vintage year, we look at our liquidity profile, what we're expecting in the way of distributions every year, and we say, if, you know, based on that, we could put X to work safely. But given that we are notably overweight, we're going to put Y to work so that we're still involved in the market, but conscious that we are trying to assume, you know, reach an assumed rate of return is based on a very clear strategic target allocation. And right now, it's not where it needs to be. So that's sort of what we're dealing with in terms of allocation.
Yeah, it's a very challenging environment right now. I echo the same thing. We've been trying to hammer home the importance of sticking with your long-term targets. And because there have been very few realizations these last few years, maybe some of our allocations more recently have been a little bit lighter, just because people are wanting to stay around their targets. And it has helped a little bit that we've tilted a little bit more into private equity here recently, just again because of the desire to move away from public markets. But where we have really emphasized a lot more has been private credit and private real estate in this market, because it is especially challenging. The reduced liquidity we're seeing in private equity, and especially again for individual investors, it's a high hurdle to get them to sign up for something that might continue on for 15 years. And you don't want to be the one selling to the secondaries fund, because you want to be buying the secondaries, not selling into those funds. So we've tried to really emphasize that if you're going into these things, you have to go in eyes wide open. That's going to be a long-lived fund, and that has caused a lot of our clients to kind of migrate away from that. De-emphasizing it, I think is probably a better way to put it, and especially since I think in the current environment we've got a lot of attractive opportunities in private credit, in private real estate, makes a compelling alternative with a much shorter duration.
Similar to dollar cost averaging into like a 401k or any investment program, one of the guys on our team is constantly reminding us we need to stay on vintage. So you've got to make a long-term commitment to it, and it's hard to be tactical to these investments. So one of the things I am questioning is if a vintage comes up and it's leverage buyout and it's time to put another one in, should we rotely expect that we need to be in buyout for the next vintage and stop and ask ourselves, is perhaps this not the right environment for it? But the research that we have looked at today suggests that when you look at forward returns on private equity in general, it is highly correlated with public market multiples. So the higher public market multiples are, the higher the forward returns are on private equity. And we could sit here and talk for all the reasons why that makes sense, but it's a very direct relationship. And so if we're talking specifically about where do we think there's opportunity in 2025 and 2026 is one area that we're looking at that looks like it could do well is in the growth equity, where there is an imbalance of demand and supply. Venture and growth equity, money is pulled back from those markets because we haven't seen the funds that should be maturing, they're not maturing and they're not cashing out, but there are still companies that need that money. So again, if you're thinking about are you a price taker or a price maker, you can be more of a price maker in those spaces if the shortage of capital is there vis-a-vis the demand.
Great, okay. Let's touch a little bit on hedge funds. I know you mentioned you all don't use any hedge funds, right? I don't know, Jason, if you want to comment on that, and if you think about it more in terms of, from an asset allocation standpoint, as a substitute for fixed income, or a defensive equity structure, and Dakia, you can follow after Jason. And where you're seeing the opportunities now in that space too.
Yeah. So the hedge fund exposure that we have now is almost entirely market neutral. So by default, that means we're investing in a lot of these platform multi-strats, which we could probably spend a whole hour talking about the pros and cons of that. But the benefit there is I think they do a really good job of managing the risk associated with their books on a day-to-day basis. And while that does not look very sexy on most of the time, you hit periods like 2022 where that was the one asset in our portfolio that was up, and it was up significantly. So we have mostly funded that bucket from fixed income. There's a smidgen of equity funding in there, but mostly from fixed income because the mandate is a cash plus mandate, and hopefully you can eke it out year after year. We try and emphasize also with individual clients because taxes are a big issue, and shocker, these are not tax efficient vehicles. So we've tried to move that as much as we can for folks who have tax deferred accounts, IRAs, et cetera, to do it there. But even if you are doing a taxable account, you're still, if you're able to get cash plus 400 or 500 basis points, which high single digit return, even netting out taxes, the fact that you're getting that sort of bond-like after-tax return without any correlation to stock or bond markets, it's still kind of a layup from an optimization standpoint, from a portfolio construction.
We work similar to David, so we don't have a discrete hedge fund allocation within our special situations allocation. We do have a couple of hedge fund strategies there, maybe a multi-asset, multi-strat strategy, maybe another bank settlement type of fund there. But again, our committee is thinking about we should be taking the risk we need to take, not just chasing alpha just to do it. So very measured, and so we don't poke the bear.
Okay, great. I think we've worked our way around the primary components of most asset allocation. So I wanted to touch on a couple other topics. One is, you can't have a panel unless you talk about AI. So just have to ask the question. I'm just curious if you're seeing, if you all have figured out any ways that you have been able to utilize AI in your jobs, because I feel like everybody's talking about it, but when you actually say to people, what are you doing with AI in your job? Like, well, I'm not really using it in my job, but I use it for my personal stuff, like planning trips and things. Or if you've come across any managers that have any interesting strategies that are utilizing AI that you think might be a differentiator down the road, or even sooner.
So I think a part of this job, all of us maintain a healthy sense of fear of fear. So I'm known at my company as an AI contrarian because I can think of a million ways for something to go wrong that does not have human judgment attached to it. Something as simple as a capital call, sending a wire, a capital call, to the wrong location. Who wants to tell the committee that you did that? Because the AI got one digit off. Eyes focusing. So it's called repetitive routine work, but to me it's called, oh no, right? So I am a contrarian. However, we are noticing that our trustee banks are finding ways to be more efficient in the way that they handle performance reporting and some of the operational work that they offer for the plan through AI. But I will tell you a story just recently, and this is something the CIO does not like to do. CIOs do not like to restate a return result after it's already been published. That's a cardinal sin, right? And I'll just go ahead and let you do the math. So I've been with Southern Company 25 years, all working on this pension plan. But before I came to Southern, I did money management for high net worth individuals who had accounts at Schwab. I reconciled accounts, calculated time, weighted returns, you know, everything you can imagine from scratch. You got the Series 763. So you'd be surprised when you pull out those skills of yours in different times. And there's 9 of us on our team. And there was an error in the benchmark calculation that with all of those pair of eyes, busy eyes, smart eyes, somehow I caught during like the MLK holiday or something. And if you have to restate, make it better. So the benchmark return was not nearly as good as had been previously stated. And so when I started using words like restated in my staff meeting, I could hear my team saying, oh, you think it'll just, you know, the wash is not really in 2 years, but it's in the 4th quarter, and it's in my year to date, and it's wrong. And I said, let's feel better about it because we're at least showing that the lag, we told them that it's not as bad. But when we told the committee, and I called up my boss, the senior VP of finance, and said, I gotta pull it back, I gotta restate, I don't like it, but I'm gonna do it. He said, you actually just gave credibility for you being such a stubborn person. He didn't say person. Stubborn person when it comes to AI and your contrarian view. Because your eye caught what the computer didn't. With JP Morgan and all their fancy bells and whistles, when I hire people and they're young analysts, I say, you hear names like Morgan Stanley, Goldman Sachs, JP Morgan, you think they're beyond air, they're like magical people. They're regular, everyday people, just like us. And they made a mistake. And they were picking up wrong returns for a completion strategy we had on our duration match fixed income portfolio, and it made a difference. But just scanning it from those years and years of working from the bottom, I was able to see something that just didn't make sense. We checked it, double checked it, and it turned out I was right. And my boss said, now when you are in the meetings with other officers and you say, I'd rather you try it out in IT and you try it out in generation and supply chain, then I'll be last. I don't want to go first. At least you have something to point to where human judgment, I still believe, is very valuable. So I'm the last advocate of AI. That just happened.
Can't spell the key with AI.
Right. But I can still be a contrarian.
So, look, there's a lot of validity when you just said it, and I think we're early stages of this, and I don't know the folks that we invest with, how they're using it or not using it. I'm just smart enough to know that there's this generative AI versus predictive AI, and we're now in the generative phases, and I think that there's a couple of examples how we are using it internally, but it's very high level. So we just engaged with a company that will do all the note taking for you. So you sit in meetings with clients or what have you, it writes it up, it summarizes it, and that's supposed to be a time saver. So I also want to know, well, if we're going to invest in this, whose job's going away, or how much of the time is being saved, what are you going to do with it? Another area that we're using it is in, there's a company out there that for new account paperwork where mistakes are being made all the time by humans on our side. There's a company that professes that with, I don't know what they get, but how they do it, but they're gonna do all that for us. So we have an AI doing new account paperwork for us. It's a job that nobody really wants. It's boring, it's tedious, it's probably over and over, and I can see how you could get mundane and make mistakes, but we've got AI doing that. How they're checking it, I don't know. So I'll cross my fingers that they got something behind the scenes to check it, but we're sort of dipping our toe into it.
So and saying the prayer for you to help me. Pray.
Praying is not a strategy. But I hope it is.
It's not even trust but verify. It's like don't trust
Right.
and verify.
Right.
Right.
Yeah, I think we've been using it internally for a couple things, mostly note-taking. It has been a big time saver there. Again, there are errors. You have to go back and check there, and quickly while the meeting is still fresh. The other thing is we have a team member on our investment team who is a quantitative risk management analyst, and so he does a lot of coding to do analytics, and he's like, this is amazing. This is essentially like having a junior coder working for me. The code that I get is buggy, but it's 80% of the way there, and that's a huge leap forward for him. I will say that a number of our managers, that's been the place where I've seen a lot of use, and especially the hedge funds. They've really been leaning into this in terms of trying to have AI help them with trading and coming up, basically analyzing how the flows of a stock have been, and hopefully making the trading more efficient, or working with the live trader, suggesting some trades that could be made, and even stretching out to a couple funds that we've looked at, and one that we actually invested in that has a portion of their money being run literally by models that have been created by AI, where it's looking out and trying to find patterns. And most of the time, the patterns that they come back with, it's like, you look at it, you can say, okay, this is X, this is Y. But there are a couple of the patterns where they're like, we don't even really understand what's going on here, but it makes money. And so they are doing that, obviously, in a very risk-controlled way. You don't want to just throw a bunch of money at a black box, but we've seen a lot of really forward-leaning usage there, especially in the hedge fund space, which perhaps not surprising.
All right, I have one more question, then I'm going to open it up to the audience. Totally unrelated to what we've talked about so far, but I'm curious if you guys have an analyst or a strategist or a podcast related to the investment space that you really listen to and really like to follow. Someone who you think does a really good job. I stumped them.
So,
Nobody.
so I don't have any specific podcasts, but I'll tell you, I'm an avid Wall Street Journal reader. I feel like there's just a lot of news in there. And it's funny, when I was younger, I don't know what they call it now, but I used to go to the C section. I want to read all the, about investments. And now I'm like, I just stay in the A section because I read a lot of macro stuff. And so I'll read that. I listen to Bloomberg, I listen to CNBC, whomever's not in a commercial. And I just pull it all together and create a mosaic. And so I listen to like all sides of everything and try to figure out what's the information that's relevant, and then draw conclusions from that. Folks that I will read, Howard Marks, love his stuff. Jason Schreiner, his strategist, I like when he writes stuff. I think he's been around long enough to have a full understanding of what's going on. And the other guy I respect a lot, and to say this doesn't mean I don't respect anybody else, but the guy's stuff I'll read is Robert Knott, and someday he's gonna be right. Not that he's a bad guy, it's just he's always on the wrong side of the equation too. But those are sort of the handful of things that I find useful for me.
Not one particular person. I think I've had overfilled for the election and talking heads from every side of the aisle. I just don't see any of them. I will have to say, when I saw that question, Allie, I thought about, and maybe this is the nature of the beast, but P&I is my favorite publication. Every headline I read is something that I wanted to know about and I'm curious about. Something even as simple as, we know that ESG has been a hot topic, and some states have decided and taken very hard lines in the sand about how they want to be exposed to ESG or not. And now all of a sudden, CalPERS and some other state plans have taken a weird position on Tesla shares and investing in Tesla shares. And it's almost entertaining. Like, what are we do? Are we pension managers? Like, what we're losing? But it's entertaining to see what other CIOs are talking about with their committees, what their stakeholders are interested in. that's my go-to every morning and really throughout the day, the announcements. That's the place I feel like I'm gonna get it, you know, unbiased data, you know, truth. And it's very related to what I'm doing. And I track through the OCI
I'll echo, yeah, that's good. I'll echo what David said about, I think for me it's more about volume, just sorting through and building that personal mosaic. Because I don't think there's so many good viewpoints out there. I hate to fixate on just one or two. One thing that I do come back to with some regularity is William Bernstein. It's a lot of his work on asset allocation and just how economies have evolved over time, which I think provides fantastic big picture perspective. I have a couple of his books that I will, in some of the smaller pamphlets that he's, I guess, self-published through Amazon at one point, that I will pull out just to try and recenter on big picture items, and not to get lost in the day-to-day. It's we moved into new offices a few years ago, and they put up TVs, and you know they like tune them on to CNBC and Bloomberg, and I'd be like, turn that off. Like I don't even want, you know, like that is just noise. And since I'm not trading, like obviously if you're trading, that is not noise, but trying to maintain a longer term perspective, and I think it's very important to fall back on Bernstein and people like that.
Great. All right. Why don't we open it up for some Q&A?
What's the one thing that you wish that you could invest in, but you can't because of either institutional constraints on your board side or constraints of risk tolerance of the people that you're working for?
My friend has reminded me to keep it in mind. Every one of us can hear a really good impact fund story. It resonates with us, and we can see that, you know, the availability of capital is not as, you know, broadly available to all types of investors. I'm looking at Lisa, who's so very successful in the venture capital space and finding those folks who need capital but just didn't have access to it. I have a little bit of room to think about those things in foundation portfolios and non-ERISA accounts, but ERISA is very clear. It does not say, don't get me wrong, it does not say that impact investing is not allowed. It actually says that we expect for you to diversify in the best interest of participants, and sometimes that means putting together complementary strategies. But when it's very clear, at the end of the day, it must be with a single eye toward the participant, right? Then I can hear a lot of great stories, but my first priority is gonna be those linemen that keep the lights on, and all the folks who are depending on my team. You know, you should see the people who whisper at us in the hallways. So next year is my year, make sure it's right, I'm retired. You know, there's a lot of people counting on us to make a decision with a single interest of what is in their best interest to meet their liability and their pension benefit year after year for the rest of their lives. And so, but if I was where's Al? If I was a foundation, ooh, I think I can do some real nice things. But ERISA is very clear. Those of you who know and who have to abide by the law of ERISA know what I'm talking about.
What he's saying, if you didn't have those, if you were a foundation, what would be the one thing you would put your money in that you can't do anymore? What's that?
I want to say what Lisa said, but Lisa has some really good ideas. Just everyday people who are finding solutions to simple, like when we were out for COVID, what's the stock, was it Zoom or which one of them did so well and made people millionaires overnight? Was it Zoom?
Zoom and
Peloton.
AMC.
The idea of finding people who can visualize a solution, find a problem, find a solution, find the capital to make it a scale product and bring it to market. That's exciting stuff. That's the stuff, I think Lisa has a fun job. I think my job is fun, everybody listening. My job is fun, but I
When are you
think.
retiring? Let's
I know.
let's get in trouble.
But I really admire you for the work you do. It's very exciting and it's very purposeful. Mine is too, just in a different way.
I don't know that there's anything that we can't or invest in. I mean, there are some things that are really esoteric that I'm like, none of our clients would understand this. And even beyond the AI hedge funds, that at least you can sort of explain. But you know, in an Asian credit strategy, to have why am I doing this? Things like that sometimes get excluded. But we've tried to, half of the fun of my job, I think, is, you could call it that, is trying to come up with creative structures to allow us to access things for people without creating liquidity mismatches. And so we've created a lot of pooled vehicles that our clients can use to get access to managers with higher minimums, things like that. So it really is only on the more esoteric side that I think if you're at an institution, you can kind of make a small allocation to that we just rule out off the bat because the clients are not going to tolerate it or understand it.
I'll put Ariel on the spot. My colleague Valerie King is back there. And Ariel has a new fund, I think it's called Project Level Up or Level.
Project Level.
Level, and it's all focused on what's happening with women's sports. And I saw Melody Hobson speak recently at the Rotary Club, and she said the highest value women's team right now is a soccer team valued at $250 million.
Whoa.
She said the highest value men's team is the Dallas Cowboys, valued at $11 billion. She says in the research that they're doing at Ariel, if you look at merchandise, viewership, every arrow is pointing in the up direction for women's sports. I had a daughter who played basketball and was a two-time back-to-back state champion here for Woodward Academy. And this is my time of the year, right? So if I wasn't doing what I was doing, I'd be on that team, working on that project, asking the folks at Ariel for a job. That's fun stuff. That's fun, meaningful, get on the page early stuff. Kudos to Ariel for doing that for women's sports.
Okay, hi, I'm Joe Hurley here in Atlanta, and I'm in the hedge fund business for the last 30 years plus, audits all the way back, and I've been in this industry for 45 years. So I'm going to ask you to find smart people. Are you concerned about Goldman Sachs thought that the next 10 years are going to produce 3% in the S&P 500? Did someone say Howard Marks up there earlier? Like -6 for the next 10 years? I mean, that's a bit of an issue for the standard way we've gone about business. And the other one, on a positive note, we've got a great manager out in California, was with Millennium for years, but he's quite bullish on the banking stocks. And a lot of the regional firms he thinks are going to be bought out. We had a manager come in from London the other day, said, well, there's already been 14 deals done in the US this year. I didn't know that. But anyway, so he's right. He thinks they're going to reprice the whole group as these smaller guys get bought up. So what about the big picture? And then maybe what about bank stocks, regionals? Thanks.
I want to take the bank stocks, but I'll talk about that dire return scenario. As you know, when we are setting strategic asset allocation, we're looking at the most efficient mixes out there and which ones best help us reach our goals some 10, 20 years from now under various market conditions. Some very pessimistic conditions, some very optimistic conditions, and we stress tested for some really down years, maybe 2 really down 20% years, followed by a period of just 5% over 7. We stress tested to death. On the accounting side, on the pension expense side of the house, they are even more conservative than we are, right? Because that affects our balance sheet. And they are doing modeling that anticipates a really negative scenario that persists over time. I guess when you were asking your question, I think about when we go through those processes and we make decisions on the best mix that we think can meet the obligation we're trying to be over a long period of time, there will be periods of significant downturn. There will be dislocations and there will be sustainable periods of downtime. I mean, the market bubble, you know, the tech bubble, right, that persisted, that was small, but in the 08 crash, really by March of 09, it was kind of self-correcting. I still haven't seen that worst case scenario that I see when we're modeling our projections in the future. We are accounting for what some may predict. That gives me the ability to rest at night. But my friend Dave said prayer is not a strategy. But I still say the rosary, and I pray that does not happen.
I don't want it to happen either.
I know.
No, I like praying too.
Okay.
But I gotta, I gotta think about this question, and I think there's a couple of ways I could respond to that. And the first is, and I mean no offense to anybody who's in the capital markets, brokerage industry, but if you were to tell your clients that you could expect 10% over the next 10 years from equity markets, do you think you'd be in a mad rush to go and hire an advisor? Or if it's going to be really challenging and you get -3, you might need some help with that. So that's just a thought. But I also started thinking, like, since you've been doing this for 45 years, you remember the dire threats of peak oil?
Yep.
I worked around oil in 1972. You remember when Japan was going to be the dominant and only asset class in 1989. Here we are 40 years later. So
Finally got back to new highs.
I think that what that prediction fails to consider, and I'm not a Pollyanna by any stretch of imagination, but it ignores technological innovations. What is going to be the next iPhone? What is AI going to do? What is going to be the game changer that we can't even think about today? All right, in 2007, the iPhone was a concept. It has changed the way we do business. It has changed everything. The internet pre-2000, 1998, changed everything. So I think that when you look at the math and you run the numbers out, you say from today's starting valuations, from today's cost of borrowing money, you can get to the math and go, yes, it's going to be a pretty tough 5-7 years. And I'm not going to dispute that. We run our models out and we come to some stuff that's just not really, I would say optimistic. But so what? What happens over the next 10 years? We're investing for decades.
That's right.
And so if that is the case, and I'm not saying it's wrong, I'm not saying it's right, you have to deal with it. And this is, something you said earlier, which I think we all need to think about too, is if the market does do -3% and I get -2, I'm not going to call that a win. We have to go back to what do people actually need? And so there's a whole concept of relative returns. I'm off topic here in a minute, but relative returns should be like completely diminished. I mean, just get rid of it. Because so what if the market's down 20 and I'm down 11? I don't call that a win.
No, individual money,
Right,
they don't
that
care
doesn't think about that. Even a foundation or a pension fund shouldn't think about it that way. But anyway, where I'm going with this is, I won't argue with the math, but I'm not sure what it's going to be. There's a couple of guys out of Canada, Brian, I forget his brother's name, they're twins, the Bolio brothers. They're big on the Vistage circuit. But they've been calling for the greatest depression beyond what happened in 1929 for well over a decade now. And it's all about demographics. That there's just not going to be enough people to support the next generation. I mean, it's the same problem Japan's going through. And you're going to have more money coming out of the system than going into the system. So those demographics suggest, just alone, is that you could back up that premise. But between now and 1929, it's only 4 years from now, what if AI does something that we don't know yet? Right? Somebody asked a good question earlier, like, what is it going to do for it? I have no idea. But I didn't know the internet was going to do what it did in 1998 and how it changed business. So I'm optimistic that there's something out there that we don't know yet that will, even if we do have a couple, 3 years of negative growth, the United States of America is very resourceful. We'll figure out what that is, and we'll find a solution to it, and we'll lead the rest of the globe in figuring out how to get out of place. It's just the way I approach things. If I look at it the other way, glass half empty, I'm probably not going to have fun getting up in the morning. But it's a good question, and I think there's more to it than simply just extrapolating out today's starting point.
David, I like your thoughts because what I've noticed over 45 years, bulls make more money, they're happier. Those bears get a chance about once every 10 years.
Yeah, well, I mean, I'll just, I think when you look at the math, you can make it say whatever you want, because a lot of it is predicated on what the going out multiple is going to be 7 years, 10 years from now. And the one thing that I would argue is that it's hard to make the math work for a 10 or a 12 over the next 7 years. And so that has really informed our pivot towards assets where we think we can make a 10 or a 12 on a consistent basis. And that's more probably not just floating down the stream with equity beta at your back the way we have the last 15 years, and more trading strategies, the private credit, the private equities, et cetera. And yeah, I mean, if you look at most of our clients, especially ones that we've had for a while who have stayed disciplined about investing and getting their vintage diversification in, we have significant amounts of money in private capital, and you would be, if you're a 60-40 investor, you probably are sitting at in the 30s, 40% in public markets at this point. So I think that's our hedge against this, is I'm really shooting for, that's how I would love it if we get an 8 or a 10 out of public markets, but if we don't, I still feel confident we can get it somewhere else.
There's a question in the back. Yes, sir.
Speak loud.
Yeah, speak loudly, sir.
Yeah, so my name's Sam Janisic, fixed income trader. My question was, well, private markets are really hot right now. What's the biggest headwind you all see over the next 3 years in that space?
Did you say biggest head fake?
Headwind.
I'll say that I think the thing that worries me the most is kind of the rise of these mass market private vehicles, and how that is increasingly turning on the spigots, especially into larger deals. And it annoys me because you see, especially in the journal, a lot of these articles around private equity. Private equity valuations are out of control. Private equity returns are terrible. And they are looking at just a small subset of the massive, and it is probably on a dollar-weighted basis accurate, but I think you have to look out of the mainstream. And I think that's going to be the same case with private equity, private credit, and private real estate, that they're increasingly, these private markets today are not the same way they were 20 years ago by any stretch. And we are trying to, it's forced us down market in almost everything that we're looking at. So the private credit, smaller deals where it's more credit intensive, and you're not bidding against 20 other people. Same thing on the real estate side, same thing on the private equity side. So that to me is the biggest headwind that I see, is just the amount of dollars that keep flowing.
Which is just going to drive the returns lower.
Right.
Yep.
Yeah, that's somewhat related to what I was going to say. We know that private equity makes sense when you're participating in the top quartile of best performing managers. As that number squeezes, then it's a why bother question. And so we want to make sure we're getting access to the better performing deals out there. And for someone like me who does a pension plan and has turnover in committee seats, a lot of fiduciaries aren't comfortable yet with lack of transparency on how these investments are doing over a 10 to 15 year holding period, when I can tell you what the Mag 7 did in the last 6 months. They want look-through and transparency that I can't give. I have to explain it's a different kind of asset class. This is what comes with it. There's illiquidity, there's a J curve, there's this, there's that. And then you have some leaders who just looking back at you and like, and? How we committed 25 million to Bain Capital 4 years ago. You're telling me about they haven't really had a distribution yet, but you think it might be a pretty good, IRR, but you're not sure. That's really how you answer questions on the front end of private equity investments with fiduciaries who are not accustomed to lack of transparency. So that's a big mountain to climb.
One more? Yeah. The last one. Jasmine Bueller, UBS. Questions on digital assets. Where do you see the role playing, whether it's hedge funds, whether you're buying assets or ETFs, regulations changing, and you marry that with AI, quantum computing, the possibility of real estate. So who's thoughts on digital investment?
I've been a deadbeat downer, I should say.
Like digital assets, do you mean like cryptocurrencies?
Bitcoin, stable coins, any type of not game coins, that's a joke.
Yeah, I'm going to give you a very brief answer, probably one you're not going to like. I don't have a lot of thoughts on it, but I don't see those as investments. They're speculative. I can't. There's no cash flow. There's no intrinsic value. So at this point in time, we do not invest in that. Not to say at some point we may, but today it's not to me something that I can say this is my expected rate of return based on some research I've done. It's nothing but just one step short of gambling, in my opinion.
Yeah, I'd say the same thing when it comes to actually the cryptocurrencies. If I have no way to value it, how can I recommend it? The one thing that we have seen a little bit on our venture and growth equity investments has been some of the firms that are living kind of on the Ether platform, using blockchain. So I think the technology behind it is potentially very transformative, but in terms of like investing in actually the crypto assets, if we don't have any insight to bring, we're not gonna go there. So that's been our exposure is extremely limited.
Check out the Texas Stock Exchange because they have recruited very heavy hitter, highly regarded names in the industry and what they're doing.
Texas Talk Exchange.
Stop.
Texas. Oh yeah, I did read that. Did something out. Okay, thank you.
But we believe in smart people like you.
All right, well, let's give a round of applause to our awesome